On our last multi-bagger stocks video, the comments were flooded with requests to analyze several stocks that our YouTube community believes are potential multi-baggers. Now today, we're going to analyze 5 of these stocks requested by the community to see if they're actually potential compounding machines over a long period of time. So first off, what's a multi-bagger? Very simply, a 5-bagger is a stock that goes up 5 times. So if you buy it at 10, it goes to 50. A 10-bagger, 10 times. 100-bagger, I think you figured it out now, 100 times. Stock number 1, Veeva. Now, $36 billion market cap. First thing I love is enterprise value is below the market cap. Net debt, very good. Another thing I love, free cash flow is $1 billion, net income $600 million. 5-year free cash flow is about $800 million. 5-year net income is $460. So this basically tells me I love when I see free cash flow greater than net income. Usually it's flipped the other way and you kind of go, okay, what's going on here? Now, like a lot of big companies, cloud-based software solutions, leading supplier for the life sciences industry. So it seems to be a little bit more niche than other cybersecurity and cloud-based security systems. Great gross margin, 73.4%, which is every extra dollar they sell, how much goes to that bottom line before taxes. And then the bottom line profit, very consistent of 24%. Big time growth. So I don't know anything about this company yet. I see big growth, 10-year, 25% a year, 5-year, 21%, 3 years, 15%. So as it gets bigger, the growth rate is slowing. Let's go see how much of that growth rate is from acquisitions. So we're going to go to the cash flow statement. And guys, that's what I love seeing. Blank, $8 million, blank, 500 million, 450, blank, 100. So guys, a lot of this growth is organic growth. I love seeing that because that is the start of a good multi-bagger. I don't like multi-baggers that have to rely on acquisitions to make their growth. This is one that's growing, so it's got a lot of runway. One of the downsides to this in multi-bagger is that market cap, $36 billion. It's a larger company. So the growth potential, the multi-bagger potential needs a lot of time there. If you want to make the 100-bagger in 10 years, you got to find the small companies, sub $1 billion that can really grow. That's harder here, okay? When you're here on this big multi-bagger, this big market cap, you can get the big multi-baggers, but it's going to be a combination of the company growing and buying back cheap shares. Are the shares cheap? Well, maybe. 36 times price to free cash flow doesn't feel cheap, but if they're going to grow at 30% a year for the next 10 years, that's pretty cheap. So let's see what their analyst estimates are for revenue growth. All right, low double digits, 2.4 all the way to 4.5 billion. Not really huge, but still a nice growth rate. Earnings per share growing in well over double digits. So again, a lot of good potential here. The 8 pillars are wonderful. Now they have been buying back stock, which is a check mark, but we don't really know. The bottom line is I really wish the stock was much cheaper because the fastest way to multi-bag is to buy back cheap shares. Cheap shares. That's the key there. Okay. So for this one, let's see on Stock Analyzer tool. Let's start doing some, a 10-year, let's do a 20-year analysis for this big multi-bagger. Revenue growth, we're going to go 6, 10, and 14. Profit margin, I'm going to go to 22, 24, and 26. Put a little bit more profit in there as time goes on, but look at this free cash flow. Free cash flow is insane. Let's go 35. Let's go 37, 41, and 45. Now PE. I don't know, guys. The ROIC is declining. This is kind of a concern of mine here. Declining return on invested capital. And it's kind of in a very crowded space. Let's go 14, 17, and 20. And let's do our 9% desired return. Hit the analyze button. So it's not exactly screaming cheap today. 10.5% potential return based on today's price. So remember, multi-baggers tend to look expensive early on, but this is a $36 billion company. I'm not exactly sold on huge multi-bagger potential. Could it be a good company long-term? Sure. I think there are other better cybersecurity stocks out there. Stock number 2, MELI, MercadoLibre. This is the Amazon of the Latin American countries. This company, huge growth. One thing I like about them too, good balance sheet, $108 billion market cap, $120 billion enterprise value, $5.6 billion free cash flow versus $1.4 billion net income, $2.34 billion free cash flow in the last 5 years versus $450 million. So if you're looking at just from the PE perspective, Barf City, 77 for the last year and 240 for the last 5 years. But look at this free cash flow number. 19 in the last year, 46 multiple for the last 5 years. Great return on invested capital. Again, big market cap. So where do you get this growth from? Where do you get the growth in the multi-baggers? From hopefully if the stock falls, they're buying back cheap shares. This might be cheap at 19 times free cash flow due to their growth potential. Better gross margins than Amazon. Better profit margins than Amazon. Yeah, this one's interesting. What's the all-time high here? Very recent. It's at all-time highs, basically. Now, I was cynical about this company for a while because I believe when we looked at it in the past, the free cash flow numbers weren't as good as they are today. The multiples were not as good. But look at this now. I mean, this is great returns on invested capital, getting better. Let's look at the 8 pillars here. Shares outstanding are up slightly. Okay, that's not helpful, but low debt. The shares outstanding being up 2%. It's not helpful, but I get it. If it's expensive, people think it's expensive. Revenue growth, netting. Look at that free cash flow growth. They had basically no free cash flow 5 years ago. Okay, so this one is the Amazon of Latin America. We have houses in Mexico. Everybody down there orders from MercadoLibre. Everybody loves it. Whenever I'd ask somebody down there, hey, I need to get something for the house, where should I go? MercadoLibre. And this has been for years now. It's not just a recent thing. Question is, can Amazon acquire them, incorporate them? I don't know. Maybe Amazon will just compete with them and continue competing with them. Let's see. One thing I want to see is a big jump in their net income. I mean, look at this revenue growth, guys. Look at this. 550, 650, 850, 1.2, 1.4, 2.3, 4, 7, 10, 10 and a half, 15 and a half, with 17 and a half in the last 12 months. Big growth, guys. Big growth. Let's see how much of it's from acquisitions. Go to the cash flow statement. Very little. 56 million. Okay, so blank, 56, 7, blank, 4. I mean, very little acquisitions. I love this. This is great. 10-year growth rate. Stock was at 130. It's already been a freaking 15 bagger from 10 years. 10 years ago. I got to add this to my watch list. Let's put this on Stock Analyzer. Let's see what it looks like. MELI. I did it January of early this year. Oh, let's see what analysts are saying first about growth rates. EPS, huge growth rates. Oh my gosh. Oh boy. Could this be a great company? So I did a 10-year analysis. 8, 14, and 20% revenue growth. Profit margin, I did 4, 6, and 8. So the question becomes, is 6 too low? Is this 8% they just got reasonable? This is a company, guys, that's going to feel expensive, but maybe it's not expensive. All right, I did 15, 20, and 25% on free cash flow. I think that looks low now. Let's do 20, 25, and 30. PE, I'm going to go a little bit, I'm not going to worry about PE. Price to free cash flow. Let's just start with, I'm going to go a little bit lower on it, 19, 16, and 22. Let's do 9% across the board. Analyze button. I mean, look at this. Based on today's free cash flow number, we're at 3,500. High side 7,500, low side 1,600. So if you like these numbers and you focus only on the free cash flow, this is a stock to look at. Do further research. Even your community, enter the community and talk about it. Stock number 3, very, very big stock. Meta. Now, guys, first order of business, $1.36 trillion market cap. How do you get a multi-bagger out of this? Well, you hold on to it, you buy it, and you hope that they keep growing that free cash flow a ton because they have increasing return on invested capital. They have great margins of 81% gross margin, and they keep driving that profit up. And if the stock falls and falls and falls, let's say it fell in half today, start buying back your shares. They would take the price of free cash flow down to 13. And don't forget, they're losing about 10 or $12 billion per year on the metaverse. So either they're going to shut that down, take the L and add 10 billion, increase their free cash flow by 20 or 25%, or it's going to be a huge success and they're going to absolutely jump up their free cash flow. And they still have WhatsApp, which they've barely, if at all, monetized it. So guys, a lot of potential. 3.5 billion people every month use a Meta product, whether it's Instagram, Facebook, Oculus, or WhatsApp, out of the 8 billion people in the world. Now, it is harder, much harder, to get a multi-bagger out of very high market cap businesses. They've already gotten the multi-bagger out of them. Now, that doesn't mean you can't still do well. It's got to be a combination, remember, on multi-baggers of long runway and great margins, great ROIC, a lot of potential there. Size-wise, this is going to be hard. Very, very difficult. Now, I'm thinking about the 100-baggers. Now, you can still you just have to hold on to the stock for a long period of time. You just got to be patient, because if this stock grows at 10% a year for 20 years, you've doubled 3 times, which is an 8-bagger. Analysts, let's look at the 8 pillars. I'm quite sure I know what it looks like, and I do. Guys, 27 times free cash flow seems expensive. I'm glad they were buying back shares when the stock had fallen hard, but should they continue to? Maybe. 42 times 5-year free cash flow, 27.5 times last year. Everything else here is a check mark. Free cash flow growth is higher than net income. Guys, these guys are printing money, and this 81% gross margin is insane. Insane. What do analysts think the growth will be? $21. So basically 50% increase in their EPS over the next 4 years. 50%. And revenue growth in the high to low single to double digits. Not bad. But again, Meta was a big part of this. Like, the metaverse could be a big loser for them. So let's pull up this Meta. And guys, we have a lot of people in our community talking about Meta. A lot of people. So my 10-year analysis, 4, 7, and 10% revenue growth. Profit margin, 27, 31, 34. Free cash flow, the same thing, because they've been pretty consistent on their net income to free cash flow. PE, 20, 23, 26. I think this is a premium company. I think you got to pay a premium for a company like this. Absolutely necessary. And my 9% return, hit the analyze button. So currently it's a little overpriced based on the market. So I'm going to wait, of course. And remember, guys, to get the multi-baggers, it's important to buy it as cheap as you can. So as it drops, you got to be ready to not follow the stock price and the news on the stock price. You got to be ready to focus on the emotional aspect of investing, which is the hardest aspect of investing, but that's what determines success in investing. It's not the numbers. It's being able to look at the numbers and say, I don't believe what the market is saying. And that's very difficult. When I started this channel, I focused only on the numbers. If you saw from the very beginning, we had the financials up. People would say, Paul, how do I get that software? How do I get that software? And I'm like, it's kind of hard to get. But as time has gone on, our channel's changed considerably. My thought process has changed considerably. Emotion is what drives the returns, because you've got to in order to beat the market, you've got to think different. When stocks are high, everyone thinks the stock is great. When stocks are low, everyone thinks the stock is bad. But you got to be buying when it's low and quote unquote selling when it's high. And that's difficult. But that's why I created the software. That's why I created all these tools, and more importantly, the community. Because you can sit there and use the stock analyzer tool to determine your price, and then use the community to sit there and have conversations about where the stock is. Is it emotional? When we see red days in the market, our community loves it. Now, as you've probably seen, we have limited spots in our community because it's more important for us to have quality versus quantity in terms of members. We're going to grow bigger and bigger, but we want good quality people who are dedicated to this thought process. And as time goes on, right now, these are all included in the software. That's going to switch. We're behind the scenes right now doing that. That's happening very soon, because our goal is to make more concentrated groups. Like, we have the YouTube channel now for real estate. Real estate's going to be taken out of this very soon. You need to buy it separately, because we want people to have a separate group to talk to, a separate community. But right now, you're still able to get everything right here. Go to everythingmoney.com/sign up, or click the link in the description below. You can get all of these tools included forever and in your pricing tier forever if you go there. And it's only $7 for 7 days. So guys, if you want to change the way in which you think about investing, probably make better returns, but more importantly, sleep better at night when stocks are falling, this would be a great place for you. Go check it out. It'll be well worth your time. Stock number 4, Vertiv, V-E-R-T-I-V. Vertiv Holdings is hardware, software, analytics, and ongoing services ensure its customers' vital applications run. Now, guys, you'll notice that a lot of the multi-bagger potential is in companies that are tech related. Why? High gross margin. So the more and more they grow their sales, the more and more they can grow their profit. High returns on invested capital. They require less capital in the business, and the capital that is in the business gets a very high return and can crank out more and more profit. That's what's really important. Now with Vertiv, we've got low margins overall. This could be part of the growth process, a lot of expenses along the way. Again, free cash flow is much higher than net income. You have almost double the free cash flow in the last year and over double the 5-year average. You can see that we have that. Same with like a company like Palantir. There's a lot of free cash flow in there, and there's a lot of depreciation and expenses along the way that get assigned to this software. That could be a big part of it. From a price of free cash flow perspective, it's 34 versus 66. Okay? Another thing, again, market cap 33 billion, enterprise value 39. Now, it's only $6 billion on $1 billion in free cash flow. And look at this itty bitty dividend. Guys, Vertiv, what the F? Guys, why would a big multi-bagger pay a dividend? A big multi-bagger is a company that can use their cash to keep growing and growing and growing. Why pay a dividend? And why pay this pathetic dividend? This is like NVIDIA's 0.000000001% dividend. Doesn't make any sense. Okay, let's go see the 8 pillars. Oh boy, this is one of the worst ones we've seen. Low ROIC, which could be because of its growth, increase in shares outstanding, a lot of long-term debt. Yeah, I'm just going to go ahead and look at this one and think to myself, let's go look at analyst estimates and see, is there amazing growth potential? I mean, yeah, I don't agree with this one. I mean, look at analysts who are going to be showboating everything. 7.8 billion to 10.7 in the next 4 years. There's no multi-bagger here. It's not even a huge growth company. Yeah, guys, I'm sorry. I don't see the multi-bagger in this, but by all means, if you know more than I do at the stock, which you probably do, because it's the first time I've heard of it, comment below on why you think I may be missing it on this company. But I'm not even going to do stock analyzers. I don't look at this and think this screams multi-bagger. I don't see the growth potential. I don't see, the analysts don't even see the growth potential. And they're paid to see things that don't exist. All right? So stock number 5, our final stock, ELF, E-L-F. This is one I've heard a lot about lately, ELF Beauty. It had a big run up to an all-time high of 221 and then has fallen now to $115. It got as low as $88 last October. Return on invested capital is getting better. Great balance sheet again. Oh, hang on a second. 6.8 billion versus 7.2. Look at the free cash flow, 40 million versus net income. So the net income is significantly higher than the free cash flow in the last year. In the last 5 years, it's pretty much even. So you have to understand, why is this big difference between last year and this year? It's selling for 100. Okay, so again, we go back to the whole idea of multi-baggers and great companies can look expensive as they grow. Absolutely. Is that the case here? Is that the case? What's going on here? Let's go look at the income statement. So 190, 230, 270, 270, 280, 318, 392, 57. What caused the big increase, the 3x in revenue? We need to understand that story. Because in multi-baggers, the story is so important. You have to make sure that story is something that can grow into something huge. It's got to have that long runway of growth. That's going to happen with a story. Great gross. Look at this growth. They have software gross margins, 71%. Great growth. Look at this, 41% for the last 5 years, 48%. So the growth rate was even increasing. Let's see what analysts think. Analyst estimates. Wow. Big growth in EPS from $3 to $5.66 in the next 3 years. Revenue growth from $1 billion to $1.085 billion, $1.85 billion in the next 3 years. 85% increase in revenue in the next 3 years. And I love the fact that it's not followed by 100 analysts. Let's go look at the stock analyzer. Have I ever done ELF? I think I have one time. Did I? I did not. Okay. So let's do a 10-year analysis. Now, this is going to be hard because we don't have a lot of history, but 85% in the next 3 years. Let's go 10, 16, and 22% revenue growth. Let's do profit margin of 9, 10, 10.9, 10, 11. Free cash flow margin, even though it's lower, I'm only going to go a little bit lower, 8, 9, and 10. PE, a lot of growth potential. So I'm going to go 18, 21, and 24. And I'm not exactly saying that's correct. That one's hard to do. But a 9% return, remember, That's just the market return of 9 or 10%. This to me will tell me intrinsic value. This has zero margin of safety in it. You've got to put margin of safety, especially on smaller companies. Hit the analyze button. I mean, I was assuming pretty good revenue growth numbers, and we're at the low side of 45 or 50, high side of 9 to 100, and a big high side of, middle size of 90 to 100, high side of 175 to 190. So I'm looking at that going, okay, is there potential there? Maybe so. I have to do more digging to figure that out because that's really important as a story in these companies. So guys, if you wanted to see the 18 stocks that I currently own, watch our next video. Thank you for your time.